So you're prepping for that trading systems and quantitative techniques exam. I get it. It's a beast. But hey, we're here to help you conquer it.
Absolutely. We'll break it down, make it digestible, highlight what truly matters. Think of it as your focused study session. No wasted time.
Right. No fluff, just the good stuff.
Mm.
We're diving deep into Chapter 12 today, folks. Trading system development, quantitative analysis, all that jazz.
All the tools you need, not just to pass the exam, but to walk away truly understanding how to build, test, and evaluate these systems.
Exactly. And we're laser focused on those learning objective statements,
Yeah.
making sure we hit all the crucial points.
Yeah, those are like your roadmap to exam success. Let's get started, shall we?
Let's do it. First up, trading systems. The chapter doesn't sugarcoat it, though, right? Building a trading system that consistently makes money.
Oh, it's tough. It's really, really tough. Less than 1% of ideas actually make it to production. Think about that 1%. And for professional traders, maybe they come up with one truly new system a year.
It's pretty humbling when you put it that way.
Definitely. And it underscores why having a systematic approach is so crucial. You need a process, rigorous testing. You can't just rely on a hunch or intuition.
A hunch and a prayer won't cut it here. All right, so our first learning objective, comparing 5 common trading models. What are the main approaches out there?
Okay, let's start with trend following. It's pretty much what it sounds like, identifying a sustained market movement and going with it. Buying when the price is trending up, selling when it's trending down, ride those waves.
Okay, buy high, sell higher.
Mm.
Classic.
Then we have mean reversion. This is the idea that prices tend to revert to their historical averages. So you're looking for deviations from that mean and then trading on the expectation that it'll go back. Kind of like buying low and selling high, but with a statistical twist.
Interesting. What else? What other models are out there?
There's scalping. That's a high-frequency game, very short-term. Scalpers are making tons of tiny profits, getting in and out of trades super quickly. They need liquid markets, of course. Then there's pairs trading. That's market neutral. You find 2 assets that are historically correlated, buy the one that's underperforming, sell the one that's outperforming, hoping they'll converge again. And finally, arbitrage. That's exploiting price differences for the same asset or very similar assets in different markets. Kind of a buy low, sell high, but across markets. It's like the holy grail of trading. Risk-free profit, but you need a sophisticated setup, and it's pretty rare these days.
Right, almost like a free lunch, but not quite.
Uh-huh.
Okay, so you've got your trading idea, you've picked your model, run some tests. How do you decide if it's worth pursuing? That's where the go-no-go metrics come in, right? What are we looking at here?
Right. These metrics are essentially your key performance indicators. They tell you, hey, this strategy has potential, or maybe ditch this one and move on. The most obvious one is net profit. That's the bottom line, right? And this is important, you can't just look at net profit in isolation. You have to consider the drawdowns, those losing periods.
Right, because a system that makes a ton of money but then has a huge drop could be really scary to trade.
Exactly. Then we have the profit factor. Divide your gross profit, the total profit from your winning trades, by your gross loss, total losses from losing trades. You want that number to be above 1, obviously. A good system will usually have a profit factor somewhere between 3 and 5. And interestingly enough, if it's way above 10, that could be a red flag. It might mean you're over-optimized to the past. Curve fitting.
So a super high profit factor isn't always a good thing.
Not necessarily. Then there's the total number of trades. You need enough data points to have confidence in your results. At least 30 trades to even consider it, but ideally more like 100 or more. The more data, the better.
Makes sense. More trades mean you're less likely to be fooled by a lucky streak. What about winning percent? How important is that?
Well, winning percent really depends on the type of strategy you're using. Trend following systems might only win 30% to 50% of the time, but their average win is much bigger than their average loss. Scalping, on the other hand, could have a winning percentage of 80% or 90%, but the profits per trade are tiny.
So it's not just about winning, but winning big when you do win, and losing small when you lose.
Exactly. You need to look at the average net profit per trade, the ratio of average winner to average loser, and of course factor in slippage and commissions, especially for high-frequency trading. Those costs can eat away at your profits.
Absolutely. Real-world costs can make or break a system. Okay, let's talk risk management. What metrics are crucial there?
Maximum drawdown is a big one. That's the biggest peak-to-trough decline you've experienced. You want that to be as small as possible. It not only tells you about the past, but it also helps you figure out your position sizing and how much leverage you can handle. Then there's the Kalmar ratio, which is just your annualized return divided by the maximum drawdown. It basically tells you how much return you're getting for the amount of risk you're taking.
A higher call-MAR ratio is better, right?
Generally, yeah.
Yeah.
Active traders really like that one because it focuses on the potential for downside pain. Okay, so we've got a good handle on how to evaluate a system. Now, how do we actually generate those buy and sell signals? That's our next learning objective. Explaining the 4 ways of generating trading signals. Where do we start?
Give me the methods.
Well, the most common one is historical backtesting. You take your trading rules and apply them to past market data. See how they would have performed.
Kind of like a time machine for your trading strategy.
Exactly. It's popular because, with optimization, it can make your system look really good, sometimes too good.
Right, because the past is always clear in hindsight.
Exactly. So it's a good starting point, but you can't get too carried away. Then there's out-of-sample testing. You split your historical data into 2 sets, one for developing your strategy and one for testing it. That way, you're not just optimizing to the same data you're using to evaluate.
So you're making sure your system can perform on data it's never seen before.
Right. Then there's walk-forward analysis, or WFA. This is even more sophisticated. You optimize on a chunk of data, test on the next chunk, and you keep rolling that window forward.
Oh, I see. So you're simulating real-time trading, seeing how the system adapts to different market conditions over time.
Exactly. It's really good for identifying systems that are either overfit or just generally more robust and consistent.
Okay. And the last method?
Real-time analysis, also known as live testing. It's the ultimate test, right?
Yeah.
You're trading in the real market with real money.
The rubber meets the road.
Yeah, but it's slow. It takes time to accumulate enough trades to have confidence in your results. You might be waiting weeks, months, even longer.
Patience is a virtue, they say. All right. Our final learning objective in this section is analyzing the 7 steps to a consistently profitable trading system. This is like the recipe for success, right?
It is. It's a blueprint.
Yeah.
And step 1 is the foundation. Document your trading objectives. These need to be super specific and measurable. Don't just say you want good returns. Say you want a 15% annual return with a maximum drawdown of 10%, or whatever your goals are. Make them clear and quantifiable.
Goals are good, especially when they're measurable.
Exactly. And it's not just about profit either. Think about risk management, consistency, liquidity you need to be able to enter and exit trades smoothly, adaptability, robustness, even transparency for regulatory purposes. All of that needs to be factored in.
It's like a holistic view of your trading goals. Okay, what's step 2?
Describe the trading idea in detail. What markets are you trading? What time frame are you using? Daily charts, weekly charts? What's the historical period you're testing on? What are your entry and exit rules? How are you managing risk? All those details need to be spelled out.
Leaving no stone unturned. Step 3.
Basic testing. Now you're putting your idea to the test. Run some back tests, maybe optimize a few parameters. You're looking for a preliminary indication of whether your strategy has legs, if it has potential.
Okay, so a first pass to weed out the duds. What's next?
Step 4 is walk-forward testing. Remember, we talked about that. This is key. You're simulating real-time trading, seeing how the system adapts to changing markets. If it can't meet your objectives here, it's probably best to just scrap it and move on.
A tough love approach, but probably necessary.
Probably. Step 5. Monte Carlo analysis. This is where you stress test your system, run tons of simulations, see how it performs under all sorts of market conditions.
Really put it through the ringer.
Right. It helps you understand the range of possible outcomes, manage risk better. But keep in mind, it's based on models and assumptions, so it's not perfect.
Gotcha. What's step 6?
Live trading. But, and this is crucial, start with paper trading, simulated trading. Get comfortable with the system, make sure it's doing what you expect. Then, if you're consistently profitable, start small. Don't go all in right away. Gradually increase your position size as you gain confidence.
A slow and steady approach to live trading. Makes sense. And finally, step 7.
Adjust your leverage based on your maximum drawdown data. You want to maximize returns, of course, but you also need to stay within your risk tolerance. So use that historical drawdown data to guide your leverage decisions.
Okay, so we've laid out a complete framework for building a profitable trading system. Now let's shift gears to applying quantitative techniques. This builds on some of the concepts from Level I, right? The importance of having a systematic, data-driven approach.
Right. It's about being objective. Using data to test your ideas to make informed decisions. Remember the basic investment process. Information, idea, action. Quantitative analysis fits right in there, between idea and action.
The bridge between a hunch and a trade. All right, so learning objective number 1 in this section. Outlining each step of the quantitative process. What's step 1?
Define your risk limits. How much can you afford to lose? How much are you comfortable losing? What's your risk tolerance? This has to be decided up front. before you even start building a system. Step 2 is to select your universe. What are you trading? Stocks, futures, a specific sector.
You have to define the playing field.
Exactly. Step 3 is choosing your data time frame. Do you want to trade intraday, daily, weekly? This depends on your strategy, your risk tolerance, your account size, even the trading costs involved. And keep in mind the signal-to-noise ratio. Shorter time frames tend to have more noise, more random fluctuations.
Right, more noise makes it harder to see the true signal.
Exactly. Okay, step 4 is defining your rules. Your entry rule, your exit rules, your stops. Keep those entry rules simple, avoid too many parameters. The exit rules, on the other hand, those are super important for your profitability. And make sure your stops are in place to protect your capital.
In, out, and safe. What's step 5?
Visualize your rule. This sounds simple, but it's often overlooked. Plot your rule on a chart. See if it's actually capturing what you intended. Does it trigger when you expect it to? Are there any unintended consequences?
Sometimes seeing is believing. What's next?
Step 6 is signal testing. Test your entry rule in isolation. See how it performs historically. Then refine your exit rules and stop levels based on those results. That's step 7 and 8.
Okay, so we're iterating, testing and refining.
Exactly. Step 9 is strategy testing. Now you're putting it all together. Entry rules, exit rules, position sizing, everything. Test it on your historical data. Step 10 is analyzing those results. What's your equity curve looking like? Your drawdown? How's your cash flow?
The numbers tell the story.
Yeah. And finally, step 11, optimization. But be careful here. Optimization can lead to overfitting, so always, always, always do robustness checks. Make sure those improvements aren't just because you've tuned your system perfectly to the past.
Avoid the siren song of optimization. Got it. Now let's talk about different types of trading rules. Our next learning objective, comparing trigger rules, filter rules, and value rules. What's the difference?
Okay, trigger rules. These are your action signals. When a certain condition is met, boom, you get a signal to buy or sell. For example, price crosses above the 200-day moving average. That's a classic trigger rule.
Okay, trigger pulled.
Filter rules are different. They don't generate signals themselves, but they can tell you whether to act on a trigger or not. For example, you might have a trigger rule to buy a stock, but only if the S&P 500 is also up on that day. That's a filter.
A condition that needs to be met before you pull the trigger.
Exactly. And then there are value rules.
Yeah.
These don't give you a true-false signal, but they give you a number. They're useful for ranking signals. So, for example, you might have several stocks that trigger buy signals, but you want to focus on the ones with the lowest volatility. A value rule can help you do that.
Interesting. So trigger rules tell you when, filter rules tell you if, and value rules help you prioritize. How does this all work in practice?
The book uses the relative rotation graph, or RRG, as an example. You can have a trigger rule that fires when a stock moves from the lagging quadrant to the improving quadrant on the RRG. Then you could add filter rules, like only taking the signal if the benchmark index is in an uptrend, and then use value rules to rank those signals, maybe based on the angle of rotation or the distance from the center of the RRG.
Okay, that example makes it clear how those different rule types can work together. Now let's talk about analyzing signal test results. What are the key metrics we need to be looking at when we test our entry signals?
All right, so first up, mean return. You want to see that on an annualized basis. That tells you how much you can expect to make on average from each signal over a year. The probability of gain is also important. What percentage of signals actually lead to profitable trades? You want that to be reasonably high.
Okay, so we're looking for profitability and consistency.
Right. Standard deviation tells you about the variability of the returns. A lower standard deviation means more consistent results. You also want to look at the number of signals generated. You need enough opportunities to trade, but not so many that it becomes unmanageable or expensive.
Right, you need a sweet spot.
Exactly. Then you want to look at the signal's average return plot. Ideally, that'll be trending upwards, showing that the signal is consistently leading to profitable trades. The shape of the profit distribution is also important. A leptokurtic distribution can be a good sign. It means you're getting more small, consistent wins.
More small wins, less big losses. Sounds good to me.
Yeah. Then compare your signal to a benchmark. See if you're actually beating the market. And look at the history bar, which shows the outcome of each individual signal. That might give you ideas for filtering or refining your strategy. Finally, run a Monte Carlo simulation and look at the plot. That'll help you assess the statistical significance of your signal.
Okay, so we've got a ton of metrics to consider. Now, the book had that example with the RRG signal where they ran 3 different tests. The final one, after adding some filters, looked pretty promising. What were the key results there?
Yeah, that final test was good. The mean return was 2.91% per trade, which annualized to 41%. The probability of gain was 57.6%, which isn't amazing, but acceptable given the high return. The standard deviation was 20.9%, and there were over 1,800 signals generated. The average return plot was positive, the profit distribution was leptokurtic, and the Monte Carlo simulation looked good. Overall, a solid signal.
A solid foundation for a trading strategy. All right, next up. Interpreting trade measures, performance measures, and accounting measures. This is where we really get into the nitty-gritty of analyzing the results. Let's start with accounting measures.
Okay, so accounting measures give you a high-level view of the strategy's performance over the entire testing period. Total return, annualized volatility, HEADR, maximum drawdown, drawdown recovery time. All those metrics tell you about the overall profitability, the risk, and the time it takes to recover from losses.
The big picture.
Right. You also want to compare those numbers to a benchmark, see how you're doing relative to the market. And there are measures like risk-adjusted returns and the M2 measure, which try to normalize returns based on risk.
Okay, well, what about CAPM measures?
CAPM measures help you understand the systematic risk of your strategy. Alpha tells you how much you're outperforming the benchmark after accounting for risk. Beta tells you how volatile your strategy is compared to the benchmark. And R squared tells you how much of your strategy's movement can be explained by the benchmark.
So it's about understanding how your strategy relates to the broader market.
Right. Now, trade measures. This is where you zoom in on the individual trades. Number of trades, gross profit, gross loss, net profit, profit factor. We talked about those already. But then you've got things like average trades per month, average profit per trade, average return per trade, average trade length. All those give you a sense of the typical trade.
The nuts and bolts.
Yeah. Then you have winning percentage, number of winning trades, average win-loss percentage, number of losing trades, average loss. That's your win-long breakdown. And there's expected value, which is a theoretical calculation of what you can expect to make or lose on your next trade.
Yeah.
Largest profit, largest loss, those show you the extremes.
The best and worst case scenarios.
Right. Maximum adverse excursion, or MAE, is the biggest loss you experienced during a trade that eventually became profitable. That can be helpful for setting stops. Maximum favorable excursion, MFE, is the opposite. Our multiples tell you how much you made or lost in terms of your initial risk. And then there's SQN, which is a single number that tries to capture the overall quality of your system.
Okay, that's a lot of metrics. Now, how do we make sense of the performance measures, like the Sherpe ratio, information ratio, Sortino ratio, and Kamar ratio?
Those are all risk-adjusted performance measures. They tell you how much return you're getting for the amount of risk you're taking. The Sharpe ratio uses total volatility as the risk measure, while the Sortino ratio only looks at downside volatility. The information ratio measures your performance relative to a benchmark, and the Kalmar ratio uses maximum drawdown as the risk measure.
Different ways of slicing and dicing risk and return.
Exactly. Now let's talk about stops, crucial for risk management. We need to understand the different types of stops and how to calculate them.
Hit me with the stops.
Okay, so there are fixed stops and trailing stops. Fixed stops are set at a specific level when you enter a trade, and they don't change. You can have price stops, percent stops, or time stops. Trailing stops, on the other hand, move with your trade as it becomes profitable, helping you lock in gains.
Sorry.
Yeah, you can have percent trailing stops, volatility stops, or equity stops. Each one has its own advantages and disadvantages.
The book showed how adding a 30% trailing stop to that RRG strategy really improved the results.
It did. Total return went up, volatility went down, maximum drawdown was cut in half, drawdown recovery time was shorter. It also increased the number of trades, though, because the stop was getting you out of losing trades sooner.
So a trade-off between frequency and profitability.
Right. Okay, last learning objective, defining robustness in the context of optimization. This is about avoiding overfitting, making sure your strategy isn't just tuned perfectly to the past data.
Right, because a strategy that works great on historical data might fall apart in the real market.
Exactly. Robustness means your system is less sensitive to small changes in the parameters. If slightly different parameters still give you good results, that's a good sign. It means your edge is more fundamental, less likely to be a fluke.
A robust system can weather the storms.
Yeah. And research suggests that optimization might be more effective when applied to things like position sizing and stops, rather than the core parameters of your trading model.
Interesting. So optimize the things around the model, not the model itself.
Makes sense. The book then gives a final strategy update where they remove the ATR exit, add the 30% trailing stop, and increase the position size.
What happened?
Total return went up even more, CTR was higher, profit factor went up, average profit went up, but maximum drawdown also went up and the number of trades went down. So again, there's a trade-off there.
More profit less often.
Right. Okay, so to wrap up, we covered a lot of ground here. We talked about different types of trading systems, how to evaluate them, how to generate signals, how to build a profitable system, how to apply quantitative techniques, how to analyze results, how to use stops, and the importance of robustness.
It's a lot to digest.
It is. But the key takeaway is that building and applying quantitative trading strategies is a process. It's about being systematic, objective, and data-driven.
And as you move on to level 3, you'll dive even deeper into things like position sizing and portfolio management.
Absolutely. So keep learning, keep testing, keep refining.
And as you do, think about this. How can you balance the desire to optimize for past performance with the need to build a system that can adapt and thrive in the future?
That's the million-dollar question. Good luck on the exam.
Good luck.